Welcome back to In Business. For some investors, this is a time to be in risk management mode. That's the strategy of our next guest. He's Rod Smyth of Riverfront Investment Group. He and his group manage almost $2 billion in assets. He joins us live from Richmond, Virginia this morning. Good morning to you, Rod. I mean, the earnings rally really choked last week. What can we expect this week?
Yeah, well, I think the market's in a very tented, nervous situation. Mainly because it's trying to get a handle, not so much on this earnings season, because I think people recognize that earnings are going to come through okay in Q2, but it's really trying to look into the second half of this year and the first half of next year and see whether this economic recovery, which undoubtedly was got going by a tremendous amount of stimulus, can be sustained.
Well, a large part of that seems to be the question of how much help the government's going to be providing for that second half. And we're hearing the president today talk about the extension of jobless benefits. We just got what was another disappointing home front figure. Make sense of the earnings versus the economy conversation right now.
Yeah, I think actually I would put it the other way and say I think it's fairly clear that the government is not going to be able to be of the same help in the next year. And so the question that I'm looking at is, can if you like, the energy that was put into the economy, we tried to prime the pump, can that deliver some kind of growth? And I think the answer that we're getting back is we're going to have some growth, but it's not going to be anything like as fast as you'd normally expect coming out of a recession. And there is a real risk that, particularly with what's going on in Europe and all the austerity measures being taken there, that Europe goes into a double dip. And so I think investors are just really nervous, and that's why we're struggling.
It sounds like you are extra concerned about the results we might be getting on Friday in terms of those bank stress test results. When you say Europe could go into a double dip, what's the trigger for that?
I think the trigger is not so much the stress test, although I would be very surprised if they come out with anything negative. No, it's simply that you have a situation where growth in Europe, like in the US, like in all the developed world countries, is weak. And you have governments pursuing pretty aggressive austerity, including raising taxes. And raising taxes on a weak economy has a very bad track record of delivering what you wanted to deliver. And so, well, I think it is worth saying, but, you know, yeah, I know that is what's happening, and that's why we're very worried about Europe, and we're very underweight in Europe. I do think, you know, amidst all this gloom, it's very important to talk about time horizon. I think if you have a 3 to 5 year time horizon as an investor, I think risky assets are really cheap and safe assets like treasuries are really expensive. But over the next 6 months, I'm definitely positioning portfolios with some cash, because I think you could see lower levels for the market and a better chance to get involved. You're
20 to 25% cash in your more conservative portfolios right now. I mean, is that your rule of thumb across the board, or are these just a few conservative portfolios?
No, we're relatively high in cash everywhere, but one of the things I think is really important on investors' minds right now is capital preservation. And so we run portfolios across the spectrum, but for those people who need income, for those people who are closer to needing their money, I don't think this is a time to be taking risks, and particularly a time to be trying to preserve capital. So what we're doing is we're buying higher quality stocks in the US, and we are willing to take risk where there's excitement and energy, like in the emerging markets, where we do see decent growth over the next 12 months.
Would you put any money to work in the financials right now?
Well, I think financials is a sector that, in my opinion, has kind of gone dead. You know, it was the epicenter of the problem. Shares fell, what, 70, 80, 90%. We had a rally off those kinds of lows. To me, that's not where market leadership is going to be. I think if we're looking for leadership, I'm looking at a sector like tech, because I think if you look at there's one wallet that's still full, and that's the corporate wallet. Governments are stopping spending, consumers don't have much money, but corporations are flush with cash. And so I think tech is still a good sector.